Hello, everyone. I hope you have enough batteries for the next speaker. It's going to be the last one in the morning, then I promise you'll get lunch to get them recharged. So my name is Lorenzo Laposta. I have the pleasure of introducing you to Fred Ingham, Head of Hedge Fund Investments at Neuberger Berman and Portfolio Manager of the Uncorrelated Strategies Fund, which we hold widely across our multi-asset portfolios. In a year like this, where traditional multi-assets have been struggling a bit and equities and bonds down, it's been great to have some diversified return streams in our portfolios. But I'll let you, Fred, describe how the magic is done. So please welcome Fred Ingham.
Thanks, Lorenzo. Hi, everybody. I know that I'm all that stands between you and lunch, so I'll try to keep this to the point. I was quite excited, actually, a couple of months ago when my colleague in sales told me that I'd been invited to the Momentum event in London in early September because I could never get tickets to the test match. But it turned out it was the conference, and I'm really glad to be here because it's been a particularly interesting year for alternative investing, and it's been quite a strong year for the portfolio. And there's a lot of interest in the space right now, and I think never has it been more relevant. So what I'm going to do is I'm going to touch briefly on why alternatives are of interest to investors today, much of which should be fairly obvious. I'll talk a little bit about some of the potential pitfalls in the area, some of the things that potentially should be avoided in the current kind of environment. I'll go on and talk about some of the things that have worked, some of the areas of opportunity, and I'll finish off touching briefly on how you might put that together. So, current environment. I mean, most of my career in the last 20 years I've spent analyzing and investing in alternative strategies, but unfortunately for me, most of that period has been the best performance in history for 60-40 portfolios, characterized by persistently rising asset prices driven by liquidity injection from central banks. If you look to for the period from April 2009 through to the end of last year, the S&P appreciated 490%. It was a pretty persistent bull run for fixed income. A 60-40 portfolio was a pretty reliable place to be. But that isn't clearly always the case. It hasn't been the case this year with the worst first half for 60-40 that we've seen historically. And even if you look back at the decade preceding April 2009, you'd see for 10 years, the S&P down close to 30%. You could note that the CAC index in France is below its peak of 2000 today, and the Nikkei still hasn't recovered its 1989 peak. So equities don't always have to go up, and nor do bond prices, and nor does there have to be a negative correlation between the two. And I think the problem for many investors today is that the reality of stubborn inflation is pushing bond prices up and equity prices down. And so the defensive characteristics of bonds in an equity bond portfolio has lost its utility. And that's the factor really that has pushed people towards investigating alternative solutions and trying to work out why diversifiers that might have been less interesting when equities were appreciating at 10% annualized rates are much more relevant today. And I think people are more willing to accept that a relatively conservative, positive, absolute return over a cycle that generates its income or trading gains from sources that are orthogonal to the broader market is of increasing value and very relevant today. So if you are going to allocate to the alternative space, where should you allocate? I focus on the liquid alternatives categories, and you see 9 of the most popular liquid alternatives categories outlined here on the slide. And what I've done is I've looked at the correlation of 20 years of returns of the indices for each of these sub-strategies to the MSCI World. So in a way, it's a proxy for looking at their diversification potential over time. On the left-hand side, you see many popular hedge fund strategies. Equity long-short is the first, event-driven is the second. These are the areas that you'll see plenty of investment in alternatives because these have worked best over the last 10, 20 years, not as diversifiers, but as sources of absolute return. Why is that? It's because they have a beta component to their trailing returns. They tend to be long biased towards the market. They tend to do well when markets go up. Unsurprisingly, those are the strategies that have really suffered this year, equity long short in particular. And some of what we've heard discussed earlier today, some of the sell-off in growth, some of the difficulties in stock picking for this year have really impacted that side of the chart. Fortunately, our area of focus is on uncorrelated strategies. And so we primarily invest on the right-hand side here. And these are strategies that for 20 years have displayed little to no correlation to the equity market. They're not always the most attractive places to invest. Their Sharpe ratios aren't always the highest. But we believe that there are interesting and relevant trades in these sub-strategies today. And if you can combine them in an appropriate manner, they can create an all-weather profile that will benefit you through a cycle. So I'm going to talk a little bit about some of the areas that we've seen working this year, and some of the areas of opportunity. And volatility relative value, or in ordinary parlance, options trading, is clearly a space that has been of interest this year and where we've seen some reasonable levels of returns. On the bottom right-hand side here, I've shown the index performance of the HFRI Volatility Relative Value Index against MSCI World and Barclays Global Ag. Not that impressive, a 4% return for the year, obviously good to be positive, but you might have expected volatility strategies to do better. The reality is there's been a very wide differential between strategies within vol that have worked this year and strategies within vol that have not. And I think a number of people are quite disappointed with potential tail protection that they had on because equity volatility hasn't necessarily performed this year. Top right-hand side, we chart the VIX, and you can see the VIX, while it has been a bit higher this year than 2021, hasn't actually really peaked, certainly to the extent that you might expect it to have done, given the depreciation in equities that we've seen this year. And why is that? Well, I think a lot of investors came into 2022 already somewhat nervous about equities. Institutional buyers in particular were hedging portfolios with put options. And so as the market started to fall, people were monetizing option hedges, which kept a lid on implied volatility and stopped the kind of pop that you might have expected in equity vol. There has actually been more action in fixed income volatility and currency volatility this year, where you've gone from a low base to a much higher base. But the change this year that has been relevant and profitable is on the bottom left. So one of the measures we look at for whether volatility strategies might perform is there a follow-through? So if the market falls on a given day, is it likely to fall the next day? If it plunges in a week, is it likely to plunge the next week? And over the long term, what you tend to find is that a falling market generates a further falling market. So if you've got an option bond and the delta starts to expand, it starts to make money, the market falls further, you make more money. 2021, you can see, was the opposite of that. We all know it was a very mean reversionary market. Every time equities sold off, they found a bid, had a bounce. 2022, completely different scenario. When equities have fallen, they've typically fallen again. And so we think that means it's an environment where being long vol can potentially reward you because you've got this floor that's been removed from the market. You know, the Fed put's gone away. Markets don't really have any reference point or anchor of value driven by protection from central banks. Investors themselves are less protected, having monetized some of those puts in their portfolio. And so that's a potentially good environment for volatility trading strategies. You know, what in particular has worked? Well, one area I'd highlight that's worked well in our portfolio this year that's been a major source of gains is dispersion. What is dispersion? Well, effectively, dispersion is buying volatility or buying options on single stocks and hedging that by selling options on indices that those single stocks sit on. Why might you want to do that? Well, index options are typically overpriced. Index options are regularly purchased by long-only asset managers and buyers, pension funds, in order to protect their portfolio. They're not necessarily particularly price sensitive. They just want to buy a 5% out of the money, a 10% out of the money put, so that they know they've got some crash protection. On the single stock side, you've got much more balanced buy-demand dynamics. And in fact, single stock volatility or single stock options can trade cheap. That's because banks sell structured products around single stocks to retail investors and in some cases to institutional investors. They then generate volatility that they need to hedge themselves on, and hedge funds can take the other side of that. So effectively, index options tend to be rich and single stock options tend to be, if anything, cheap. So buying single stock options, hedging with index, gives you a potential return. You can then use some of that value cushion in order to buy yourself further protection. So you can buy more volatility to give yourself the ability to make money if volatility rises, as well as arbitraging the two characteristics. And the interesting thing about that profile, and one of the reasons it's worked so well this year, is that the best case scenario is violent rotation within equities without violent moves at index level. Because if, for example, growth stocks are going down heavily, value stocks are going up heavily, the index itself has muted movement, but you've got a lot of movement on the individual stocks. And that's very much what we've seen this year. So if we look at the profile of P&L payoff of dispersion, and this is a carve out of one of the allocations in our portfolio, you can see that you tend to get this characteristic where you're naturally long volatility. So should there be a crisis like the pandemic, you see March 2020, you see very steep returns. But if you have a period where there is a somewhat schizophrenic market and there's back and forth between value and growth, there's rotation across sectors, and single stocks are moving a lot more than index, again, you can generate strongly positive returns. And that's what we saw particularly in the first quarter of 2022 as investors adjusted their portfolios to respond to higher interest rates and discounted future earnings back much more steeply. But you also get an upward drift over time because of that premium that you're earning. This is a somewhat more complicated chart, but the point we're making here is effectively, with this trade, you really want to have low realized correlation between stocks. So you want stocks to be behaving differently to each other relative to the level of index volatility. And when we look at it in the US on the left, or in Europe on the right, the dark dots that you can see here are the recent period. What we've seen is that correlation has been quite low, so stocks have been behaving quite differently for the level of volatility of the index. And again, that's a win for the trade. Another commonly cited area of volatility trading that hasn't done well this year is convertible bond arbitrage. Now, we've had pretty small exposure to CBR this year, so it hasn't really been a cost for us. But certainly the convertible bond space has had a very difficult year. So the first half of this year, the global convertible bond universe fell about 16.5%. It was the worst first half in the history of the of convertible bonds, looking at the last 20 years of markets. And why is that? Well, long-only buyers have seen significant redemptions this year as options in convertibles have gone out of the money. Hedge funds that are big investors in the convert space have degrossed and seen risk reduction this year as well as they've lost money through holding convertible bonds. And all of this has cheapened up convertible bonds relative to hedges. We've got two charts here. We look at the cheapness of global IG converts on the top right. So you can see some cheapness, but particularly in Europe. And on the bottom side, we've got the cheapness of European convertibles relative to theoretical prices. And you've got about 4 points cheapness today of European converts relative to where we think they should trade. So we think it's a good opportunity today to step in and take the other side of some of this selling. You hedge yourself by shorting the equity of the underlying stock. You hedge the credit, so you're not taking market directional risk. You can hedge your interest rate risk as well. Isolate the cheapness of the option and put yourself again in a long volatility position where if the underlying company falls steeply, you can realize a substantial gain. If it appreciates and rebounds, you can make a gain too. And if convertible bond prices normalize relative to equivalent credit, again, you put yourself in a good place. So converts is an area that hasn't worked for volatility strategies this year, but where we've actually been increasing exposure, and I wouldn't be surprised to see it being a source of return for us over the next 6 to 12 months, but it's a non-directional source of return. Another area that has been pretty successful for us this year is short-term trading. So again, I'm using index data here, but actually our returns on short-term trading in the live portfolio are pretty similar. So the index is up about 11.5% year to date, again, versus steep falls in equities and fixed income. What is short-term trading? Well, it's really systematic futures trading. In our case, across equity indices, FX, and interest rates and sovereign bonds. In some cases, you can trade commodities too. And really, you're looking for patterns over short time periods. It could be minutes, hours, days, or at the long end, weeks, that are repeatable in markets that are predictable in order to take both directional and relative value positions. And one of the characteristics of short-term trading, particularly in the way that we like to execute it and allocate to it, is short-term momentum models or volatility breakout models. And those models are usually looking at short-term price patterns of, it could be interest rates, it might be an equity market, looking at breakouts of ranges across different standard deviations. They'll combine those models with analysis of market volume, of market microstructure in some cases, to try to estimate, is a breakout real or false? And that tends to give you a long volatility characteristic to some extent, because if something starts to fall and it breaks through a key level, a short-term futures trader will typically get short. If it breaks out on the upside, they'll typically get long. And unsurprisingly, this year, particularly in the short-term interest rate space, we've seen a number of breaks, US 2-year particularly, US short-term futures, short-term interest rate futures as well. We've seen it in the UK too. And interest rate trading has been a pretty significant P&L generator for us this year, primarily on the short side. We also saw it in equity indices in June. So being short equities in June as the market fell and then fell again mid-month was also a P&L driver for us. And the characteristic of short-term trading is one where if you decompose returns into quadrants of market volatility historically, you'll find that on average, the strategy does better in more volatile market conditions than in less volatile market conditions. Now, if you look back over the last decade, most of the years in the last decade have been sub-average in terms of cross-asset class volatility. But I think we're now entering an environment where a contraction in liquidity that looks structural will mean that we're gravitating more towards, I'm not saying the world's going to be hugely volatile, but what it needs to do is move back towards kind of long-term volatility averages, not those compressed levels of post-QE. And I think that's where we are, and it's quite an interesting environment for these kind of strategies. Other areas that have worked quite well in short-term futures trading are actually cross-asset class models. So looking at the impact or the co-relationship between and across asset classes. So as interest rates have moved this year, there's often a lead-lag effect on underlying currencies. Or as commodity prices have moved, there's a lead-lag effect on underlying indices. And the more panicky those moves tend to be, the greater the inefficiencies and the greater the opportunities to make money. Conversely, there are also mean reversion opportunities. So some markets get stretched relative to others. If fixed income is selling off, but the Bund contract is more sticky, you might want to short the Bund and buy fixed income on the other side. So lots of different types of trades, lots of behavioral biases being exploited, a strategy that ultimately is uncorrelated to broader markets, uncorrelated to pretty much anything else, hasn't been very interesting for a lot of investors because it hasn't done much until this year, although it has been one of the best performing strategies for us over the last 5 years, but I think quite relevant to where we're going. Trend following, more easily understood, more common allocation for investors. Clearly, trend following is simply about exploiting price momentum in markets and trying to follow that momentum wherever it takes you, again, across equity indices, across fixed income and rates, across currencies, across commodities. Trend following is a strategy that I quite like, but I acknowledge is difficult for investors to hold. So we all know that momentum exists in markets. We know there's a crowding effect. We know that asset allocation decision makers are slow moving and will follow prices. It's been shown time and time again academically and in practice that momentum exists and can be exploited in markets. And yet most people are underinvested in trend following. And that's because trend following has a relatively low Sharpe ratio on a standalone basis and can go multiple years without making any money and comes with high volatility. So as a single line item, it can be difficult to explain to an investor why you're invested in this noisy thing that can go multi-years without generating a return. But the reality is trend following will often generate all of its 3 or 4 years of return in a short, sharp 6-month period. And you can see that the index was up 29% in the first half of this year, really differentiating it as a strategy in a particularly difficult market for investors. but it was, again, a bit like short-term trading, a strategy that perhaps hadn't seen as much interest prior to this year because people were more focused on long-biased investing. Where's trend following made its money this year? Well, again, I've got the US 2-year yield as one example up there on the top right-hand side. A very clear price trend. Should be no surprise that trend following has been aggressively short US short-term interest rates and the front end of the US curve this year. Continues to be short today. Similarly, UK yields have been a popular short, both at the short and the long end. At times we've been short Germany, we've been short JGBs as well. But also, more recently, the dollar has been a P&L driver for us too. So general bias towards the dollar against a wide basket of currencies. Today, some of the more popular shorts are the pound, the euro, Singapore dollar, the Indian rupee, the Korean won, but tends not to be too concentrated against any single currency. And the dollar strength, which we acknowledge to some extent is driven by the interest rate differential and the Fed leading the way, has been another driver of P&L for trend following. We did actually reduce our risk in trend following in the midpoint in June when yields reached their kind of peaks at that point in time. Underlying market volatility had picked up substantially. Some of our macro trades were relatively correlated to some of the momentum positions that trend following had been taking. And one of the things we try to do is anticipate where risk is grouping or becoming too binary in our overall portfolio, and where strategies are cross-correlating. And so some of the, I've put at the bottom left there the asset class exposures for trend following, so you can see where it's been net long and net short. You can see the net short in the dollar, you can see the net short in rates, but you can see the interest rate shorts gradually coming off over the last couple of months, and that's partly because we cut risk in the underlying strategy itself. However, duration shorts have increased somewhat again over the last month or so, and trend following is having another good month this month, and is making money both in the dollar and interest rate shorts. All of that said, things have moved a long way this year, and a lot of the hiking cycles around the world are priced now in a way that they needed to be priced and weren't priced at the start of the year. And so I don't necessarily think it's the case that there's the easy win that we saw in the first half of simply being short interest rates, being short bonds on a global basis, being long the dollar. I think what you're seeing now is a much more nuanced market where certain central banks are arguably at or ahead of the curve, but other central banks are still significantly behind the curve. Underlying economic fundamentals across countries are quite different in terms of growth and inflation trajectories, stages in fighting the pandemic, import-export balances, currency weakness, currency reserves. And all of that means that from here, you might be in more of a relative value space where you might want to pick winners and losers across countries from a macro perspective. And that feeds into the hands of global macro managers. And again, global macro, you can see on the bottom right-hand side here, has had a pretty solid year. The HFRI Macro Total Index, which goes across both discretionary and systematic managers, is up about 8.5%. Similarly, in our portfolio, we've seen some very big wins, actually. We've made quite a lot of money being long the US dollar against the euro, against the Australian dollar, against the yen, and at times against the pound. And those have been driven by differing growth across the US versus the European and UK in particular economies, and the widening yield differential earlier in this year as the Fed was repriced. I think that for global macro to work, different economies at different stages in the cycle is quite a good place to be. And I think the profile is going to be a little different because it was about outright delta, outright direction earlier this year, effectively being short rates, maybe being long dollar, whereas now I think it's going to be about picking your countries, understanding what central banks are doing on a case-by-case basis, and trying to identify the pockets of value and the pockets of overvaluation to put both long and short trades on. And so I would say that our global macro book today does remain long the dollar, which again has worked well this month and year to date. We are still somewhat short duration, but it's a bit more of a a mix than it was earlier in the year, and certainly the outright position has come down. So that leads me on to how all this is put together. I've given you a snapshot of our portfolio here, so you can see the different weightings across strategies. Our philosophy is that although I've outlined some of these strategy areas and talked about them being potentially attractive or unattractive, it is very difficult to forecast which alpha strategies are going to work or not work over a 3 to 6 month period. We find we're very good at explaining ex post why it was a good market or a bad market for underlying managers and strategies, but to try to anticipate the drivers is more problematic. So our philosophy is to say that we have 6 core strategies in the portfolio that you can see there. We've talked about 4 of them. We expect all of them to have positive long-term returns with low correlation to equity and fixed income. We also expect all of them to be pretty uncorrelated to each other. We think they're hard to time, so we like to allocate risk relatively equally across those different strategies in our portfolio so that we can hold them and benefit from the long-term Sharpe ratios. And again, going back to my earlier example of trend following being quite hard to hold, if it's a 15% weighting in the portfolio, it's there when we need it, but when it's not working, there are plenty of other things around it that hopefully can generate returns so that we're able to hold it. So that gives you an idea of what's in the portfolio today. I'm very happy to go into more detail about any of the underlying strategies, but I realize we're getting somewhat tight on time. They say that this is a particularly valid period, I think, for absolute return as opposed to relative return. You can't eat relative return. You probably do want to eat your lunch, so I'll open up for questions.